Yeah, so I'm gonna sell my energy stocks. Yeah, yeah, that's right. The rest of the world doesn't exist. I only focus on what happens in the United States because that's all that matters. Hey, oil prices are down 20%. So I'm gonna sell my energy stocks. I'm a typical American. I don't have the slightest idea what's going on in the rest of the world because it doesn't affect me. Is it possible I should rethink this strategy?
No, don't do that. That wouldn't make any sense.
Hi, this is Greg. Welcome to the channel. Well, if you've been watching this channel, and even if you're new to the channel, I have been talking for many, many months, going on years now, about energy stocks and specifically oil and gas. And we got into the energy complex in terms of investing very early in the process, going back to March of 2020. But recently there's been inflation fear in the United States, and oil has gone down 20% in the last month or so. And also Exxon, for example, of which we've had a buy on for some time, and Chevron, have likewise gone down about 20%. And it's caused me to, rethink my strategy and maybe get a little cold feet. So I believe knowledge is power, and I came across a very interesting interview with Francesco Blanch, who is the head of commodities research at Bank of America. And I found his views particularly interesting, particularly due to the fact that he's located in Europe. And so I thought I would share some pieces of that interview with you, as well as my comments and analysis. Now, if you get value out of this video, please like and subscribe. And if you do subscribe, give me a comment below and just let me know you subscribe. I promise to answer all comments. So basically what I've come to realize over the last few months is that commodities are still the best hedge for inflation, okay? This horrible inflation that we've been going through has caught everyone's attention. I've done a lot of content on this channel about it. You should definitely check it out. But commodities are still the best hedge against inflation. And foremost in the commodity complex is oil and gas. And there's two things I've been focusing on, and I'm going to focus on in this video. One is oil's relative cost or price relative to other commodities in the complex, and also what is going on in Europe, because energy is a global business. And if you just focus on the US and what's going on in the US economy and get spooked because everybody's talking about us going into a recession and demand destruction and all this kind of thing, and everyone just watches oil prices go down, and when it goes down they want to sell their energy stocks, you definitely have to check out this interview.
So we continue to see commodities as the right place to be to protect portfolios against inflation. That's the bottom line.
But how do you square that call with, say, the recession calls that are out there? Because if you hit a recession, or if you're in the camp that we're actually in one right now, isn't the commodity complex the very first trade that gets hit?
It is going to get hit, but remember, back in 2008, commodities, and particularly the spike in oil prices to $147 a barrel, was actually the trigger, one of the triggers that took the global economy down. But it wasn't really the main source of the crisis. The main source of the crisis was housing, was leverage in the housing sector, leverage in financial institutions. Right now, we don't have those issues. Right now, what we have is an enormous global gas and power crisis, which is extending into other parts of the energy complex. Think about thermal coal prices reaching $400 per ton in the Asian markets, which is about $100 a barrel. Think about natural gas spiking in Europe again, over $300 a barrel of oil equivalent today. Think about French power up another 10% and more than 50% in the past 2 weeks, over 440 euros per megawatt hour. So we're looking at extraordinary prices for commodities in the next 6 and 12 months. And obviously, this is going to create some challenges in the European economy, some big challenges, I think, in the European economy. But again, the real source of the problem is a lack of supply availability. It is possible that we see prices falling back if the situation, if the geopolitical tensions, particularly with Russia, start to fade. But I do think that unfortunately, oil at $100 a barrel is not very expensive compared to where other pieces of the global energy complex are trading.
So oil is not very expensive at $100 a barrel compared to where other types of commodities are trading within the complex. Very interesting observation. I never thought of it that way in terms of relative cost. I always looked at the absolute cost. Very interesting. In fact, it recently came out that Chevron CEO Michael Wirth said that the oil market remains tight and the price decline that we've recently seen might be short-lived. Further, he said crude oil futures have slipped below $100 per barrel as recession fears rise, but Chevron's Michael Wirth told CNBC on Wednesday that the price downturn could be fleeting and the oil market remains tight. There are a number of factors that could lead to long-term demand resurgence, including an eventual full reopening of China after the recent spike in COVID cases. Global energy markets also are being reordered after Western nations slapped sanctions on Russian energy. Okay, so the most important thing to remember here is the oil and gas business is an international, global business. If you focus on the U.S. and the U.S. economy, you're only seeing part of the picture.
Francisco, let's just talk a little bit about what you've raised there, and that is what is happening with European prices in particular. We can bring up the chart of European electricity. I think we've got the French contract here 1 year out, we've got the German contract 1 year out. French prices in advance of German prices at the moment, but they are both spiking massively. Gas prices, as you say, are extremely elevated. One is connected to the other. At what point do we get significant demand destruction? How much damage is this going to do to the German and French economy over the next 6 to 12 months?
I think it's going to do tremendous damage, and unfortunately, I think some of the policies that have been put in place have probably exacerbated the problem here in terms of the upward trend in commodity prices, and particularly in electricity and gas prices. So I think right now the real challenge is that we don't have the supply to generate the tons of steel, the tons of aluminum, the cars, the washing machines the market wants to produce. And ultimately, because Russian gas cannot be redirected, unlike, for example, Russian crude oil, which has been going to China and India, that shortfall in Russian gas translates directly into a shortfall in European GDP, and it's not something you can recover in other parts of the global economy. So I do think that the collapse in production that we are about to see, we are seeing already in some energy-intensive sectors, and we are about to continue to see in the next 6 months across the broader economy, cannot be made up by production elsewhere. And this is where I think the European economy is moving into a very frail position, and it's one of the reasons why we're seeing also the euro weakening so much in the recent past.
Well, I'm glad you brought up the story of production, because that's exactly where I was going to go next. What kind of timeline are you looking for perhaps that ramp up, specifically when it comes to natural gas exports coming out of the United States to the rest of the world? That seems to be a process that's very dependent on infrastructure and the build out in the States, in particular, export terminals, et cetera. To what extent can that still be a longer term solution to this issue?
Kriti, I think it can be part of the solution in the longer term. The problem is, over the next 2 or 3 years, all the gas that is going to come out of the U.S. Is already committed, right? I mean, people want this gas, and again, we're in the middle of the summer. This is an obvious statement, but remember, going into winter, we could see extreme competition developing between Asia, between China, Japan, Korea, and various European countries for the few molecules of liquid gas available. And I think, unfortunately, Russia is cognizant of this and is trying to use it as leverage coming into the end of the year. So that's, I think, where I think the politics have gotten mixed up with the economics to deliver, unfortunately, a pretty ugly outcome. So yes, the U.S. could help in the next 5-10 years, but it's not something. U.S. gas is not something that's going to save Europe. Remember, Russian pipeline exports are 2 times more or less what Qatar, which is the world's largest LNG exporter, produces in a single year. And in order to replace Russian gas into Europe fully, you would need to take all the gas that goes into China and Japan in a single year and bring it to Europe. Obviously, that's not going to happen. I'm talking about the LNG that goes into Japan and China, which are the world's number 1 and 2 importers of the liquid gas. So it's very difficult to replace this energy. Unfortunately, it's going to result in lower industrial activity, lower economic activity at this stage. Remember, 1% energy supply is required to create 1% GDP. That's almost as simple as that. It doesn't matter if it's gas or coal or nuclear or wind or solar, but you do need the energy. And right now, we have an enormous shortfall.
Okay, so this is an enormous supply problem. He said there's an enormous shortfall. The sanctions against Russian gas, and this applies to oil too, cannot be made up by the existing supply. Okay, this is something that we all have to understand, and this is a worldwide supply problem. And this worldwide supply problem is expected to go on for 2 to 3 years minimum, and it could go on longer. Now, this head of research at Bank of America, Mr. Wirth, the CEO of Chevron, and other people that are extremely smart in this area, including Warren Buffett, who's been buying Occidental Petroleum and owns close to 18% now, understand what is going on a worldwide basis. And again, us in America, we tend to be, insular, so to speak, and focus on the U.S. economy. You have to understand that even though this supply shortfall and the lack of gas, for example, in Europe is going to cause a lot of economic distress and slowdowns, the supply-demand imbalance is so acute that even with that economic slowdown worldwide, there's still going to be a supply-demand imbalance. The thing that really blew me away about what he said is that the exportation of LNG, liquefied natural gas, out of the U.S. is not going to replace the amount of gas that's lost by the Russian sanctions. And in fact, in order to replace that deficit, you would have to have as much LNG as is exported to both China and Japan, which is an extremely huge number, and there's no possible way that that can be made up. The other interesting thing he said is that 1% of energy supply is needed to produce 1% of GDP. So you can see how acute this problem is and how it's going to affect worldwide economic activity. Okay, so what are the takeaways from all this? I have 5 basic takeaways that I want to go over right now. The first one is oil going below $100 a barrel is probably a temporary phenomenon, and it's probably going to be short-lived. Number 2, this supply-demand imbalance in oil and gas is a global phenomenon, and it has to be viewed in the global context. Number 3, the oil and gas deficit in Europe cannot be made up by the current supply of energy in the world. This is a worldwide supply problem. Number 4, LNG exported from the United States, which is one of the largest exporters, will not make up the gas deficit incurred by Europe as a result of the Russian sanctions. And number 5, what's most important to us is that the major oil and gas companies like Exxon, Chevron, and Occidental Petroleum that we've been talking about on this channel are in the best position to supply this oil and gas deficit to the world. Exxon, for example, has the most scale and breadth in its business, in its oil and gas business, of any of the majors, and they will be a major player in how this worldwide energy deficit plays out over time. Now, I don't know about you, but as an Exxon shareholder and to a lesser extent a Chevron shareholder, I'm still feeling pretty good about my position in oil and gas relative to the demand-supply imbalances we're talking about. I love the idea that Exxon is one of the largest exporters of liquefied natural gas. They have at least 3 new terminals being constructed that are going forward to meet this demand, and it will not only accrue to the benefit of Exxon shareholders, but also will benefit the world in terms of its energy supply. So the wrap up is, unlike what I said at the beginning of the video and my musings in the lead-in, don't sell your energy stocks yet. It's premature. Look at the energy business as an international business, and it's a worldwide supply-demand scenario. And right now, everything is still working in your favor, despite the fact that oil prices have recently come down.